Hello viewers, I am Sanjeev Pandya welcoming you to the Tax Time right here on ITV Gold, a weekly show that brings you all the latest and the greatest that you need to know about the taxes. Greatest, I say that because the year 2021 has seen major changes in the taxes, personal corporate taxes, and the tax filing for the year 2021 can be different than what you've been doing over the years, and that's why you need an accountant who's knowledgeable, who's experienced, who can guide you in the right direction, advise you what deductions that are out there for you so you can take it and maximize your refund if that's possible. And that's a Sai CPA Services full-fledged accounting firm here in New Jersey, and Mr. AJ Kumar, CPA and MBA with Sai CPA Services for over 25 years. He joins us every week in the show to guide us, to advise us, and to inform us about all the tax changes. So here we are once again. I'd like to welcome Mr. AJ Kumar. Good to have you, sir, again.
Thank you, Sanjeevji. Appreciate that.
All right, thank you. As we are moving ahead, viewers, I just want to remind you, last week we said that this will be the second part of the series. Last week was the first part, the major tax changes in the year 2021. That was the topic we started to discuss last week, and Mr. AJ Kumar gave out all the information regarding advanced child tax credit. It was a very informative show. Thank you so much for watching the show, and thank you for your feedback. Once again, the email ID is taxtime@itvgold.com, and if you have any question, you can send us a question, and Mr. AJ Kumar will answer the question during the show as well. So make a note of it, taxtime@itvgold.com. Continuing now this, tax changes in the year 2021. Let's talk about updated limits in the year 2021 taxes.
Sure, Sanjeevji. So we got a lot of calls based on our last week's episode, where we talked about the advanced child tax credit, the economic stimulus payment. We talked about various other changes that we have for this year. A lot of people wanted to understand the income tax bracket. A lot of people called us, how do I minimize my taxes? If I make more than $100,000, do I have to pay tax or 22% tax on all of the income? So we wanted our viewers to understand there are 7 income tax brackets. As you can see on the screen, we have an income tax bracket ranging from 10% to 37%. If somebody is making less than $12,000, especially $12,550, they don't have to file taxes. But we advised our viewers to file taxes, especially if you have lower income. If somebody is making income over $12,550, and these income tax bracket, please understand, are all about the taxable income. If somebody is making $20,000 as a single taxpayer, then their taxable income is going to be $20,000 minus the standard deduction, let's say $12,550 in this example. So their taxable income is $7,450. So if somebody's income, taxable income, that means is up to $10,275 or $20,550 as listed on the screen, their income tax bracket is 10%. The next income tax bracket is 12%, which is from $20,550 to $83,550. If somebody is making, let's say, less than $83,000, then any income above $20,550 for a married filing joint taxpayer is computed at 22%, and the income below $20,550 is computed at 12%. So on, we have 12%, 22%, 24%, 32%, 35%, and 37%. Anybody who's making more than $647,000, this is for married filing joint, their income tax bracket is 37%. So if in this example, people who are making, let's say, $700,000, the first $53,000 is computed at 37%. Then income between $431,000 and $647,000 is computed at 35%, and so on. Their first $20,000 is still computed at 10%. So the lowest income tax bracket is 10%, the highest income tax bracket is 37%, and IRS will look at the weighted average. It does not help to reduce the income by $500, by $1,000 to change the income tax bracket, because you don't pay the taxes on the total income. So hope it makes sense. We wanted our viewers to understand the income tax bracket works on a weighted average tax bracket. If somebody is telling you oh, if you donate $500, your income tax bracket will be lower, and so your tax liability will be much, much lower. That's not how it works. If your $500 is changing your income tax bracket, you are saving taxes only on that $500, not on the whole income. Hope it makes sense.
Well, it better make sense because these are a lot of numbers. I was looking at this and a question comes to my mind. All right, viewers, if you can, maybe let's look in together. For the minimum tax bracket is 12%, right? And I'm looking at married couples filing jointly, 20,500.
Minimum tax is 10%.
Okay, 10%. Okay, there's a one more after 12%.
That's right. Minimum is 10%, then maximum is 37%.
Okay, fine. So then I'm looking at difference between 12% and 22%.
Okay.
Married filing jointly 20,550 for the 12%, and 83,550 for the married couples filing jointly 22%. There's a 10% jump between that two. That is, I think, the largest jump in the entire tax brackets if you look at it.
You are right. But if you are below $22,000, then you are under the poverty line.
I know that, but I'm just saying this is where what we say lower middle class pays the highest taxes. This is what it is.
Absolutely.
Go all the way to the top. 647,850 for the 37% tax bracket for the married couples. They only pay 37%. Difference is 15% only from the lower middle class couple to higher middle class couple.
Well, absolutely. So the way it works, the higher income people will still pay taxes at 22% on the income up to that limit.
Correct.
If their income is more than $647,850, then they pay 37% taxes only on the income that is over this threshold income.
I know that, but I'm saying the gap up here is 10%. And all the way up there is 15%, and plus all the deductions that they can get. All these, people making over $500,000, $647,000 in this case, all the deductions they can get. It's very interesting.
Absolutely. I mean, a lot of these people are small business owners. You typically don't really see this type of salary on W-2. Most salaried people are in 24% tax bracket or 32% tax bracket. Most people are.
Well, nowadays you do see this kind of salaries in IT and Wall Street and everywhere.
You do.
It is now becoming, especially it's a married filing jointly.
Absolutely.
All
so
right.
getting 150 here, 150 here is common. But making 650 is still sort of not as common.
Correct. Anyway, interesting. Thank you so much for sharing that information. Let's talk about standard deduction.
Absolutely. So standard deduction means if you are not itemizing your taxes, this is the deduction you can claim that everybody has the right to claim. So as we were saying, 12,550 for a single filer or 25,100 for married filing joint is the standard deduction limit. You have the right to itemize your taxes, especially if you own home. If you have a mortgage, then more than likely you will be better served by itemizing your taxes. On an itemization table, which goes in Schedule A, you typically see the medical expenses. Medical expenses have to be more than 7.5% of your AGI in order to be deductible. But then you have the property tax, you have the mortgage interest, and you have donation. These are the four major categories you see on the itemized deduction. If your itemized deductions are more than the standard deduction, you claim the itemized deduction. If your itemized deductions are less than the standard deduction, then you don't claim the itemized deduction. You have the right to claim the standard deduction. Standard deduction is also very helpful if you are not sure about the donation receipt. Let's say, for example, your itemized deduction is just slightly over standard deduction, but you are missing some of the receipt. And you have to remember, for donation, the receipts have to be contemporaneous receipt, meaning the receipts have to be with you at the time of filing the taxes. You cannot say, oh, I donated money to the temple, I can get the receipt if the need be. That does not work. That does not count. You have to have the receipts with you at the time of filing the taxes. This is called contemporaneous receipt. If you are not sure about your itemized receipts, your donation receipts, you're better served by using a standard deduction. In standard deduction, you're not on the hook to be producing any receipt.
Okay.
There is no obligation to be producing any receipt.
Good point. Good reminder to have receipts. All right. Quickly, let's talk about capital gains before going into the break.
Absolutely. So capital gains are typically for the investments. If you have the stock investment, if you have the property investment, when you sell these properties, these stocks, these cryptocurrency, these virtual currency, it creates capital gain. Capital gain typically are of two types. It could be short-term capital gain or the long-term capital gain. When we say short-term, it means the purchase date and the sales date is within 1 year. If you are holding the security, holding the property, holding the virtual currency or the stocks for more than 1 year before selling the virtual currency, the stocks, the property, assets, let's call it, then it's a long-term capital gain. Long-term capital gains are much lower than the short-term capital gain. If it's short-term capital gain, then the tax rate you pay is what your regular income tax rate is, depending on your income tax bracket. We'll look at your total income and we'll say, okay, based on this income, based on this marital status, single, head of household, married filing jointly, you happen to be in this income tax bracket. Whatever income tax bracket you happen to be, for a short-term capital gain, that's the tax rate you pay. For a long-term capital gain, we have different tax rate. It could be 0% depending on how much income you have. It could be 15%. The maximum capital gain rate is 20% as opposed to 37% of the regular income tax rate.
Before we go any further, when you talked about income tax brackets and standard deduction and capital gains, I noticed one thing. There is zero tax on a certain category of capital gains.
Absolutely.
0% tax.
Absolutely.
And that's where rich guys, millionaires take advantage of it.
Well,
yeah.
See,
Tell us.
the way the 0% tax works on the capital gain, you have to have a long-term capital gain and you have to have certain lower income. So if the income for a married filing joint taxpayer is less than 83,500, only then you get the 0% tax rate. For most wealthy people, it's typically 20%.
Okay.
If you have the large income, taxable income, and then you have some capital gain, then more than likely, if it's a long-term capital gain, you will have 20% tax rate.
20% is also
it's not too bad
exactly.
compared to 37% for the regular income tax rate.
Yeah,
Absolutely.
20% is not bad at all. I mean, limit is only 517,000.
Absolutely.
And especially, the surge that we have seen in the real estate market, especially after pandemic, people who made lots of money and only
Absolutely.
20%, that is not
Since
bad.
we are talking about the real estate market and the capital gain, we want our viewers to know if you are selling your primary home, more than likely you do not have to pay any taxes. If you have been living in that home for at least 2 years in the last 5 years, selling the home is tax exempt up to $500,000. If you have a gain of $500,000 for a married filing joint taxpayer, this gain is tax exempt. So just be careful. Just don't assume that you have capital gain, so you have certain tax liability. Please work with a competent.
Is it only for the year 2021 or also?
It has been there like this forever, but a lot of people make this mistake. They will include the capital gain on the sale of the primary home as an investment, and IRS allows it because the IRS allows this exemption once in the lifetime. So IRS will assume that you did not want to claim the exemption. A lot of people don't really know that they could have not reported it. They could have claimed the exemption. You have to report the transaction and claim the exemption. That is my primary home and I choose not to pay the taxes because I have been living in that home. So the onus remains on you to claim the right exemption. If you don't claim it, you pay the taxes, IRS will take the money.
Okay, interesting. Now let's move on to the other topics. Let's quickly start with retirement.
Absolutely. So a lot of things are changing. I mean, as we are emphasizing, this is very different year than what we used to have. Say, start with gift limit. Gift limit was $15,000 for several years. For 18, 19, 20, 21, it was always $15,000. Now the gift limit is $16,000. IRS has gone out of the way to increase these limits, these deductions, these benefits to fuel more money into the economy, to put more money into the market. Now the gift limit is $16,000. Please understand, the gift limit is per person to per person. So you can give $16,000 to anybody in this country, and the person who is receiving the gift does not have to pay any taxes.
Do they have to be family related?
It does not have to be family. And let's say an husband-wife giving gift to another husband-wife, It could be husband giving the 16,000 to husband, 16,000 to wife. Wife giving 16,000 to husband, wife giving 16,000 to.
64,000
So
altogether.
it can be up to 64, but you cannot have a business relationship. We can, if we see you, let's say my website person, he maintains my website. If I'm seen giving 10,000 of gift to my website and he is doing my website, it's a business transaction.
Not
It can be
acceptable.
seen
Yes.
as that I'm trying to do this transaction only to bypass the rule. The IRS has the right. Why did you give the money? If somebody is buying a home, you're loaning the money, gifting the money, because you know this person. That's different. We can relate to it, we can understand it. But if you don't know this person, why are you paying the money? I mean, what's the reason for this transaction?
Exactly.
That can be asked. But there is no reporting or no tax filing, no tax payment, no tax liability for a gift up to $16,000 in this year.
Very good. Has the limits changed for 401k or IRA?
Absolutely. I'm glad you mentioned it. So the gift limit has changed. 401k limit has changed as well. The 401k limit last year was 19,500 in 2021. If you recall, in 2020 it was 19,000. In 2019 it was 18,500. IRS used to increase this limit by $500 every year. This year IRS has gone out of their way, and out of their way means not 500 but 1,000. So IRS has increased the limit for the 401k from 19,500 to 20,500. So in 2022, from your payroll, you have the right to deduct up to 20,500 towards your 401k plan.
All right, talk about payroll. That's the right word you mentioned.
Absolutely.
I wanted to ask you about payroll taxes.
Absolutely. So the payroll taxes changes every year. At least the Social Security wage limit changes every year. For last several years, the Social Security taxes and the Medicare tax percentage has not changed. Social Security tax continues to be 6.2%, Medicare continues to be 1.45%. The limit is changing on the wage base. Every year the limit changes. Please understand, 50% of the Social Security tax, Medicare tax is paid by the employee and 50% is paid by the employer. So when somebody is on the payroll, let's say if somebody is on the payroll for $100, is costing almost $110 to the company. The company has to pay certain taxes on behalf of the employee based on their payroll. So 6.2% and 1.45% for the Medicare, 7.65%, we call it FICA taxes. Social Security, Medicare is referred as FICA taxes. So 7.65% is paid by the employee and 7.65% is paid by the employer.
That is the one reason they have not raised that limit. 7.65 has been there for years. I think.
Absolutely. So a couple of years ago, they reduced the limit by half, meaning you don't have to pay for certain quarters the full Social Security amount. But the limit, the tax rate has not changed. The wage base does increase. Now we are looking at 147,000 of wage base for 2022. So if somebody is making more than $147,000, they pay the Social Security tax only on up to $147,000. The income above $147,000 will not have any Social Security withholding. So you will typically notice that your January payroll, net payroll, is much lower than December net payroll, especially for the high earners, because as your income increases, once your income crosses certain threshold, say Social Security threshold is 147, then the Social Security deduction will not be there.
Okay.
It helps you increase the net pay.
Very good. Good point. Quickly, HSA, Healthcare Savings Account. Let's have quick information on that one and earned income tax credit before we wrap up the show.
Absolutely. So HSA, Healthcare Saving Account, is an account where you can put in pre-tax money, and this money can be used for medical expenses. Could be co-pay, could be over-the-counter medicine, and a few other purposes. So the idea is a lot of people are not able to claim medical expenses only because they don't itemize their taxes, or their total medical expenses are not in excess of 7.5% of their AGI. So a lot of people were in a situation when the medical expenses are not deductible on their tax return. So HSA, Healthcare Savings Accounts, provides a vehicle for such people, high earners typically, where they can contribute some pre-tax money into this bucket and use this bucket to pay for some of the medical expenses. For 2022, we are looking at $7,200 for a family, or $3,600 for a single person that can be contributed towards the HSA plan.
Okay, 3650 for single person and 73.
Well, it
73
changes every year.
Yeah,
7200 was for 2021. It changes every year.
correct. Anything you'd like to add on earned income tax credit? We got a minute to go.
Absolutely. So earned income tax credit, and it's sort of the name does not do justice to it. The earned income tax credit is meant for people who do not have enough earnings, meaning for poor people, and you can claim up to almost $7,000 in this case.
Yeah.
So people who are not making enough money, they are not required to file taxes. But by filing taxes, especially if they have children, and the limit is up to 3 children, they can claim as much as $7,000 free money from the government just by filing their taxes. So earned income tax credit, advanced child tax credit, economic stimulus payment, these are the reasons when you need to consider filing the taxes even if you're not required to file the taxes.
Very interesting, and that's why you need to contact Science CPA Services, because it can get very complicated, but Science CPA Services will definitely help you to ease out all this confusion and make sure that your return is filed well, and perhaps you are on the way to get maximum refund. That's why Science CPA Services is all about. Do give them a call, 908-380-6876 or sciencecpaservices.com. With that note, we come to an end of this Tax Time show right here on ITV Gold. Mr. AJ Kumar, thank you so very
Absolutely.
much.
Thank you.
And when we meet again next week, same place, same time, we'll have more information, taxes information. As much as you can digest, we'll bring it to you right here on ITV Gold. I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.